Hey there, fellow investors. Today, we're diving into a topic that's close to my heart: how to spot an undervalued stock like a pro. Whether you're a seasoned investor or just starting out, this skill can be a game changer for your portfolio. So, grab your favorite beverage, get comfortable, and let's explore the world of value investing together. Before we jump into the nitty-gritty, let's talk about what an undervalued stock actually is. Imagine finding a hidden gem in a thrift store. That's essentially what we're looking for in the stock market. An undervalued stock is a company whose shares are trading below what they're truly worth. It's like buying a dollar for 50 cents, and who wouldn't want that kind of deal? Now, you might be wondering, how do these bargains even exist in such an efficient market? Well, the stock market isn't always rational. Sometimes, investors overreact to short-term news, or they might overlook a company's true potential. That's where we come in, armed with the right tools and knowledge to spot these opportunities. So without further ado, let's explore 6 powerful ways to identify undervalued stocks like a pro. Let's kick things off with the price-to-earnings ratio, or PE ratio for short. This is like the bread and butter of value investing. Here's how it works. You take the stock's current price and divide it by the company's earnings per share. A lower PE ratio could indicate that a stock is undervalued. But here's the catch. You can't just look at the PE ratio in isolation. You need to compare it to the company's industry peers. For example, if most tech companies have a PE ratio of 30 and you find one trading at 15, that could be a sign of an undervalued stock. However, always remember that a low PE ratio could also mean the company is in trouble, so we need to dig deeper. Next up, we have free cash flow. This is the money a company has left over after paying for its operating expenses and capital expenditures. It's like the company's piggy bank. The more it has, the better. When I'm looking for undervalued stocks, I love to see a company with strong free cash flow relative to its market cap. This tells me that the company is generating more cash than the market is giving it credit for. It's like finding a tree that's bearing more fruit than anyone realizes. Now let's talk about the price-to-book ratio, or PB ratio. This compares a company's market value to its book value. Essentially, what the company would be worth if it liquidated all its assets and paid off all its debts. A PB ratio under 1 can be a strong indicator of an undervalued stock. It's like buying a house for less than the cost of the materials used to build it. However, be cautious. Some industries naturally have higher PB ratios than others, so always compare within the same sector. Dividends can be a great sign of a company's financial health and stability. When I see a company consistently paying and even increasing its dividends over time, it catches my attention. It's like a company saying, "We're doing so well, we can afford to share our profits with you." But remember, not all great companies pay dividends, and not all dividend-paying companies are great investments. Warren Buffett, the godfather of value investing, often talks about looking for companies with a strong economic moat. This is a sustainable competitive advantage that protects a company from its rivals, like a castle's moat keeps out invaders. This could be a strong brand, network effects, or high switching costs. When I find a company with a solid moat trading at a discount, that's when my ears really perk up. Last but certainly not least, we have intrinsic value. This is arguably the most important concept in value investing, but also the trickiest to nail down. Essentially, we're trying to calculate what a company is truly worth based on its future cash flows. One popular method is the discounted cash flow (DCF) model. It sounds complicated, but the basic idea is simple. We estimate how much cash the company will generate in the future and then discount that back to today's value. If the stock is trading below this calculated intrinsic value, it could be undervalued. Now, I'll be the first to admit that calculating intrinsic value isn't easy. It requires making a lot of assumptions about the future. But even a rough estimate can be incredibly valuable in spotting potential bargains. So there you have it, folks. 6 powerful ways to spot undervalued stocks like a pro. Remember, no single metric tells the whole story. It's about building a complete picture of a company's value and potential. Value investing isn't about finding get-rich-quick schemes. It's about patience, diligence, and a willingness to go against the crowd. Sometimes, the market will disagree with you for a long time before it proves you right. But when it does, the rewards can be truly spectacular. I hope you found this guide helpful in your investing journey. If you did, please don't forget to like this video, share it with your fellow investors, and subscribe to our channel for more investing insights. And hey, hit that notification bell so you never miss an upload. Remember, investing always carries risks, so always do your own research and consider seeking professional advice before making any investment decisions. Until next time, happy investing.